Hello everyone, how's it going? In this video, we're going to be talking about Mullen Automotive, trading under the ticker symbol MULN. So recently, Mullen just released some major news regarding its operations in Europe and the products that can be rolled out now. So they have secured the distribution right of iGo, small compact vehicles that look like little little SUVs for the European market. Mullen believes that there is a need for, quote, ready-to-market urban delivery vehicles in Europe. So my understanding is it's either like the Amazon-esque or the Uber Eats-esque type of deals, because those small vehicles, they're relatively, economic in all kinds of expenses. They break down less often. Um, their purpose is to deliver goods instead of people, because the drivers and the passengers might not have like maximum comfort in those vehicles. They have passed the European, like the regulation standards, and they have mentioned that they will make the first deliveries of iGo in Germany late this year. The electric vehicle will also have a starting price of just about 12,000 euros, outside of like the VATs or transportation costs. So the target audience for this vehicle is, like we said previously, the last mile delivery companies. So, food deliveries, parcel deliveries, and so on. But because it's relatively small, I would say that, for large quantity goods, this might not be the best choice. In that sense, it kind of makes sense because lots of Uber drivers apparently also choose EV vehicles. And when I say Uber drivers, I'm saying like people who carry passengers, not just goods. For them, they often choose vehicles like Prius in order to save on gas and fuel, because it's a relatively cheap option in the long run. I mean, we have to remember that EV vehicles over the years, they have gotten down a lot in their prices, and also the hybrid vehicles as well. So the company has initiated the licensing talks with other potential partners, and they want to sell like iGo through dealerships. The iGo is not a proprietarily made vehicle. This is important. So this is not made by Mullen themselves. Mullen doesn't disclose who is the manufacturer. With that being said, there are some indications that it is manufactured by an external partner, and it's currently sold for less because it doesn't carry like any sort of brand or logo that is from Mullen. So in a nutshell, Mullen is going to probably like dropship a bunch of cheap cars made by others on the European market. They have the right for distribution, and the vehicle is relatively cheap. So this is the gist of what's going on at the moment. So, by the way, when we talk about like $12,000 or 12,000 euros for a vehicle, usually, especially for a new vehicle, they're usually small vehicles. They're usually vehicles that are like more like toys, if you will, than full-size SUVs that can carry the whole family. Not only that, but carry the whole family to a place that requires like hours of driving without really recharging the fuel or the battery. This is not one of those cars. I think that it's mostly made for like city-bound circulation, intramurals, if you will. So it does have a pretty competitive price, but we have to remember that this car is not a proven product yet. We don't know where it comes from. I don't really like the lack of transparency in this case, but you know what? It's going to bring some additional cash flow to this company, because otherwise they're going to keep diluting shareholders until like the stock is delisted from NASDAQ probably. But basically, my point is, I do believe that Mullen has obtained itself a sweet deal here, because it doesn't have to bear the manufacturing costs. It doesn't have to bear like the related regulation cost in order to benefit from a new product. They just have to distribute it. Okay. And because they're going to be working with dealerships on top of it, what this means is that they don't even have to find like dealers for them. So probably what's going to happen is that those dealerships are going to work off a certain percentage, and then Mullen will get whatever percentage that there is left. Okay, I'm not even sure that they have to assume like inventory costs or whatever. My feeling is that they don't have to assume this kind of thing because they can just be stored at the dealerships. And regarding whether they should keep some stock in the ports or warehouses, I think that they're going to be using something akin to like just-in-time inventory management. By the way, speaking of Europe, small weird cars and distribution, it kind of reminds me that in Europe, if you really start looking around, there are a lot of like smaller companies making unlicensed cars. They're essentially like hobbyist cars. There's a certain parallel to be drawn here because the iGo vehicle, if it can be made by a company that I've never heard about, then there is an argument to be made that essentially this kind of product has been standardized. So this is one of those signs that electric vehicle is getting more standardized over time. But beyond these remarks and beyond this major catalyst in the right direction for Mullen, I do believe that one, it does have its soft parts. It does have like the parts that can seem a little bit wobbly, but I think that to the very least, it's going to give Mullen a higher baseline going forward. Okay, and it's probably not going to make new highs with it, not even going through like the current resistance around the $1. Now, as a result of this news release, the stock went up by about 33% on Monday's trading session, but it's still down by about 91% year to date. On one hand, things look kind of bad. On the other, the price is also very cheap, and so far, this has marked an inflection point. There's about 25 cents, which can be considered as a pretty hard support level. So overall, I would say that the price action has been encouraged, but we're still a bit far from like certainty of whether this positive momentum will keep going on. Now, I just want to mention something that kind of took me a little bit by surprise, and it's also interesting about Mullen and the EV sector in general. On some articles, when I was doing my research, even when it's about Mullen, there's a portrait of Elon Musk. So Elon's portrait can be plastered on some articles that don't even talk about Tesla, but are talking about like companies in the same sector. So from this, it kind of shows me how dependent of Tesla's valuation and the outlook the market, the sector, has become. Okay? So we really have to check if in the future investors are going to one day change their mindset and say, hey, you know what? Tesla is one of those companies that makes cars, right? Instead of running on combustion engine and fuel, instead of electricity and batteries. So given this, I think that we have to be careful about whether one day investors are going to say, hey, you know what? These are just car manufacturers. Okay, they're like Toyotas, they're like GM, they're like Ford. And by the way, in terms of sales volume, they're much lower than the traditional manufacturers. So we have to be mindful of this. We have to be mindful how dependent Mullen is to like bigger fish in the same pond. Tesla, Neo, Lucid, that kind of stuff. Rivian as well. So with that being said, I believe that if it can manage to keep the current gains, it's already quite a feat, to be honest. Meanwhile, the external factors that can still push the stock downward, or at least grind to a halt, are still there. The conflicts around the world, the inflations, the recessions, and the slowdowns of main economies. So unless these change, I think that we're going to have a hard time arguing for Mullen to make new highs. Because that's not going to happen in the foreseeable future. But in the meantime, we may not get this kind of cheap price for the next few years to come as well. Okay, so I'm not saying that we have bottomed just yet. even though when the stock kind of inflects at a very low price point, historically speaking, this is usually a potential sign that things are changing. So my recommendation is to buy at least 30 to 40% of your allocated amount in Mullen now. The rest can be DCA'd further down the line. So I think that it can be DCA'd, over the next 12 to 18 months, assuming that Mullen is still there. Because, and this is the other thing. With where the company is at the moment, there could be a scenario in which nothing that we've predicted over the past few months about Mullen ever happens. This also happens in financial markets sometimes, because we can talk about the theoretical scenarios all we want, but if it just doesn't happen, if nothing happens, then, this is going to change our outlook, obviously. So with that being said, I would say that the exposure to Mullen should be between 0.5 to 1.5% of your portfolio. And remember to DCA even when your allocation is very low, okay? Because this is a it's at least high risk. I don't know if it's necessarily high reward kind of title, but it can also punish hard as well. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.